What companies deserve your hard-earned dollar? Which would you want to work for? How can you know if they share your values? Just ask us. Just Capital is a nonprofit that tracks who really means business in supporting workers, customers, communities, the environment, and shareholders. We measure progress, track success, and help them be better. When you see the Just Capital seal, you know what's real, because just business is better business. Visit justcapital.com to learn who makes your dollar count.
And good afternoon. We are doing it live right here. Weekday afternoons at 4 o'clock. We get right down to business with the news-driven hour. We're doing more in 2024 now at 4 in the afternoon. It's Mottek On Money, live on the air here in 790 KBC, streaming live online worldwide at kbc.com, and the on-demand Mottek On Money podcast at kbc.com, Apple, iTunes, and all your favorite podcast platforms. Stocks at or near record highs on Wall Street and record rainfall on Main Street in Los Angeles. Please drive gently as this latest wave of this atmospheric river comes through Southern California right now. The 790 KBC News Department, of course, following the latest here in Los Angeles. And later this hour, I'll get an update on how businesses in Orange County are being impacted by the storm. I'll be speaking live with Jeff Ball, the president of the Orange County Business Council, also former head of the California Association of Bankers. A lot to talk about on a proposed new retail crime law here in California, a rail line through San Clemente. We'll also talk banks, too, given with what's going on interest rates and commercial real estate. Today we heard from Treasury Secretary Janet Yellen in response to a question about the resurgence of regional bank risks. She spoke before a House committee hearing, said regional banks have a concentration of commercial real estate lending and office properties, and some cities are of special concern because vacancy rates have increased. Yellen is chair of the Financial Stability Oversight Council. She said bank regulators are quite focused in helping banks manage through these problems, including by working with banks to manage risk. Lots going on in the banking sector, so we'll talk more about that later. Also, we're seeing the stock market ending higher today, with the Dow popping back up 141 points, ending at 38,521. The S&P 500 gained 11. The NASDAQ also racked up a gain of 11 points. Looks like the yield on the 10-year note eased a bit today, back to 4.10%. We're also what's happening after hours here. Snap, the company based here in Los Angeles, stock plunging more than 30% in extended trading this afternoon after the social media company, they call themselves a camera company, by the way, reported a revenue miss and offered a disappointing outlook a day after announcing yet more deep job cuts. Tough news there in Silicon Beach. Also after the bell here, we're getting a report that Walt Disney's ESPN, Fox, and Warner Brothers Discovery are teaming up to create a joint sports streaming service. The as-yet unnamed service, which could be available as early as the fall and offer a sort of Hulu model for sports, comes amid an explosion in sports streaming rights and audiences. Of course, we're watching developments in the Middle East. The price of oil ticking higher again today at 53 cents to settle at 73.31 a barrel. And in London, Brent crude moving higher by 60 cents, just shy of $79 a barrel. On the geopolitical front, we're, of course, watching developments in the Middle East and China, too. I'll discuss the latest with Gordon Chang, author of The Coming Collapse of China and the Great U.S.-China Tech War. But first, on your money, the markets, the economy, and the whole works. Joining us live now, I'm delighted to say we're joined by veteran investment expert Art Hogan, Chief Market Strategist at LA-based B. Riley. Art, good afternoon to you, sir. Wonderful to have you back with us here. How are you doing there?
Well, thanks so much for having me. It's great to be back on air with you, and I'm sorry you're getting inundated with rain. I don't usually ever have to say that to someone that lives in your neighborhood, but please stay safe out there.
Thank you very much, Art. And you're coming to us from back east, and you're right there in the heart of Wall Street and what's happening there. So give us your view of the world. It's been a while since we've chatted behind live microphones. This is our first conversation here in 2024. Give us your view of the world here at the moment.
Yeah, I'll tell you, as we enter 2024, obviously coming off a very successful year for markets in 2023, and a year that surprised most professionals, meaning we spent most of 2023 expecting the market to sell off and for the economy to go into recession. We continue to see positive trends in the economy and positive tailwinds from markets. So, if you look at over the course of the last month or so and the economic data that we've received, it's been much better than anticipated. Whether you look at the fourth quarter GDP number or the personal consumption expenditure, the inflation gauge that the Fed likes to look at that came in lower than expected. Across the board, all of the important inputs, the jobs creation number that we got last Friday, all the inputs in terms of the economy continue to be more robust than anticipated. So the good news about that is that's going to be good for earnings and revenues for publicly traded companies in corporate America. The economy is doing well. The bad news is anybody that anticipated that the Federal Reserve was going to cut rates in March has had to change their tune and push out those expectations to sometime in the spring, likely June. So I think we're at a critical juncture here, Frank, where good news in the economy can be good news for markets. We need to temper our expectations that the Fed is going to hurry to cut rates, but they likely will cut rates. And the one thing we do know after hearing Jay Powell on 60 Minutes and at his press conference last week, they're done raising rates. That's real good news. We can start looking at economic data in an intuitive fashion and assume that the next thing they will do is cut rates, and it likely happens sometime in the spring. So I think we've got a lot more tailwinds than headwinds in this market, and I think we continue to be able to grind higher.
All right, the Fed focus still on inflation, right? And now, obviously, with the price of oil ticking higher, given the upheaval we're seeing in the Middle East, once again, fuel inflation is a concern. Art, might that be something that will delay the rate reduction here?
Yeah, good question, Frank. Now, I will tell you that we have a very well-supplied global energy market, right? And that comes from a couple different factors. The first and foremost, and the most important factor is the U.S. is now producing more oil than it ever has in its history. So we're the largest energy producer in the world and at record levels. We're exporting more LNG than anyone else in the world. So we are the chief producer of energy product. That's the great news. Now, what has kept that in check is OPEC and Russia have certainly stuck to their quotas, so they're not producing as much as they can. And they're doing that to keep some stability in the price. But when you think about the average closing price on WTI last year versus the year before, so the year before the average closing price was $77. That's for the whole year of 2022. 2023, the average closing price was $74. And so far this year, we've averaged right around $74. So even with all of the Russia invading Ukraine and what's going on with Israel, Pakistan, and potentially Iran, and all the geopolitical uncertainty, we haven't seen a major spike up with some concern over oversupply or destruction of supply. And I think the important variable here is that if we were to see a temporary spike in energy prices, which doesn't really help anybody and isn't clearly inflationary, Saudi Arabia and OPEC has the potential to turn back on production. So they're restricting production now. I think they're going to be the safety valve. But right now, I think we have a very good balance of supply and demand. And one of the reasons for that is China has just failed to reopen their economy very well. So demand for energy products and all industrial materials coming out of China has been lackluster. They spent 3 years with a zero COVID policy. They have an aging demographic. So what we expected to see in demand for goods and services from China this year just hasn't played out. Now, they're working very diligently to stimulate their economy, but they haven't been able to find the right lever to pull. They've got a lot of work to do. Their demand may pick up in the back half of this year, but as that happens, I think you see Saudi Arabia, OPEC, and Russia start to take some of their quotas off and start to produce more because, frankly, everyone wants to make money. I think energy as an investment at this, between $70 and $80 is one of the most underappreciated investments right now. So we would highlight energy as an investment. We think this is a very profitable level for energy prices. If we sit somewhere between $70 and $80, most of your North American E&P or exploration and production companies, and certainly your fully integrated oil companies like Chevron and Exxon can do very well. Chevron just reported earnings about a week ago. They had a 14% increase in profits. They beat everybody's estimates. And I think that if you're looking to make an investment and look at what didn't work last year in 2023, energy is one of those sectors.
On the air live with Art Hogan, Chief Market Strategist at B. Riley Wealth Management. It's hard to believe, Art, it was nearly a year ago that we had those several bank failures last spring, and now former Fed Chair, current Treasury Secretary Janet Yellen on Capitol Hill talking about new concerns in the banking sector related to commercial real estate. What's your reaction to what she said, and are we in for some more possible bank failures here?
Yeah, Frank, you bring up a really good point. So Silicon Valley Bank started a bit of a mini regional bank crisis last March, a year ago March. And what happened then was that the FDIC stepped in, looked at everybody's balance sheets, looked at their duration risk, looked at where they had investments and where there was mismatches. And to stem that tide, they created some marriages with some of the failing regional banks into larger banks. One of those banks was Signature Bank, which actually got folded into New York Community Bank, and New York Community Bank has not been able to do very well in assimilating that asset. So New York Community Bank has been coming under pressure. I think that's what she's referring to. For obvious reasons, a lot of regional banks have high exposure to commercial real estate, not always office, but certainly a lot of commercial real estate. And clearly being concerned with New York Community Bank, which is under pressure right now, I think that was leaning into that. But it's important to remember, we have thousands of banks in this country. There was 5 that got into trouble a year ago, March. There's now 1 that we're talking about. I don't think we're talking about something that falls into the category of something to be concerned about. And the fact that office real estate and commercial real estate has been under pressure is not a new story for us. Most banks have done a good job about reserving for those. But we're going to hear some bumps in the road. There's going to be some, obviously office hasn't come back, and it's been a while that hasn't been the case. So we certainly have been under pressure in office since 2020. Here we are in 2024. There's going to be a longer road to work that out. But I think that this is more idiosyncratic. I don't think we're going to hear about a handful of banks falling in the same category, but it's certainly keeping pressure on valuations for regional banks overall.
And there was a crypto component to at least some of those failures last year. And since we last spoke, Art, the Securities and Exchange Commission has improved those Bitcoin ETFs. We saw that big run-up in Bitcoin ahead of that announcement, and then a pullback, and now a bit of a rebound here with Bitcoin at around 43,000 or so. Didn't have a chance to get your thoughts about these Bitcoin ETFs. What are your thoughts about crypto and Bitcoin at this point?
Yeah, I'll tell you this, Frank, and I think you laid that out perfectly, right? So there was a large anticipation that some of these ETFs would be approved. They were. So we saw more than 50% run up over the 12-month period that we're talking about these ETFs into that approval. And then not surprisingly, you got a bit of a sell on the news reaction, and it's grinding higher. And I will tell you, while crypto is not for everyone, it's certainly more accessible for everyone that is interested in it, right? So as opposed to having to either go to one of the crypto exchanges or opening up a wallet or finding some cold storage, you can actually seamlessly get into an ETF. It's a spot ETF that tracks the price of Bitcoin very closely, very much like the gold ETF tracks gold prices, so you don't have to buy gold and store it in the safe in your basement. So I think it's more about accessibility. Now, in terms of an investment, it's certainly too new for us to believe or understand exactly what its ultimate value will be. But there is certainly growing acceptance of the fact that it's an asset class. It's not necessarily a currency. And for those people that like that asset class and want to have exposure to it, the access point now with an ETF is low cost and it's much easier. You can put it into a regular brokerage account, and you can certainly have access to it that way. You don't have to go through all the rigor of what the early adopters of Bitcoin had to go to. So that said, it's seen as very much a digital gold asset. So whether you like gold and want to invest in that using an ETF or actually buying the precious metal, the same thing is true with Bitcoin. Whether you want to actually buy the actual cryptocurrency and store it somewhere in a wallet or in cold storage, or you want to buy an ETF, so you have equal accessibility to cryptocurrencies, and it's Bitcoin now. They likely expand that out to Ethereum. I think those are the two incumbents. I think the rest of the cryptocurrencies will be a long time coming before there's an actual liquid spot market for more ETFs to come. But right now, what has apparently happened is that the early GBTC Grayscale fund that tried to track Bitcoin prices didn't do very well. A lot of money came out of that when it's the very low cost top 2 providers. And Fidelity is one of those. So yeah, I think it's made it easier for people that like to express that opinion that Bitcoin's going higher. It's a low cost way to do it. We're not advocating for it necessarily, but it's certainly made it easier for the average investor to have access to it.
Thank you for that excellent explanation and assessment. I read someplace that these Bitcoin ETFs have more value than silver ETFs at this point. What about good old gold and silver here, Art, in this new year?
Yeah, so I would tell you this, and silver's a tricky one because silver is not just a precious metal, but it actually has a lot of industrial uses, whereas gold is largely a precious metal that doesn't have a lot of industrial uses. It's got very little. But when you look at silver, it's got much more of a component to it that it's used for industrial purposes as well. Think about things like automotive and electrical, et cetera. But that said, for the history of the precious metal ETFs, Gold has always been about 10x or 12x or 14x, given depending on the year, in popularity versus silver. So the gold to silver ratio is actually pretty far out of whack. Gold is more popular, and I would suspect that people that look at investing in either precious metals or digital gold are funneling money out of silver and thinking, okay, I'm either going to be in gold, and I'm going to do that with a GLD ETF, or I'm going to go into Fidelity's ETF for Bitcoin, or BlackRock's ETF for Bitcoin because it's low cost. It's 19 basis points, and do that. So silver has always been the sort of country cousin to the gold. Although the disparity or the delta between the gold and silver price right now is as wide as we've seen in history, so there might be a bounce there for silver. Not a recommendation here. Yeah, I think about it like this, Frank. Precious metals and Bitcoin are a hedge against what might go wrong. So I think about it like, I want some percentage of my portfolio, and this is a typical gold or Bitcoin investor, some portion of my portfolio to be in something that helps me sleep at night. So if that's gold, you might have 3 or 5% of your portfolio in gold in case something terrible happens, some geopolitical event, or there's massive inflation, or something that's outside of your control. And if that helps you sleep at night, we would never stop you from doing that. If Bitcoin is now that digital replacement for gold for you that helps you sleep at night, and it's an asset class that you feel safe in, that's fine for you. It's not my personal preference, but we would never stop anybody that felt like this is something that gives them a bit of security. And I think that's where both of those asset classes fall, and I suspect that's where they sort of land in people's thought process. Hey, I want to have a hedge against something terribly going wrong, and I'm going to have 3 to 5% of my portfolio in either gold or Bitcoin, or perhaps some mix of both, or throw in some silver as well.
On the air live with Art Hogan, Chief Market Strategist at B. Riley Wealth Management. And getting back to the Magnificent Seven, or a Magnificent Six, or some are now calling it the Magnificent Four. Looks like that list is getting a bit shorter. Certainly NVIDIA hitting record highs this week. Art, the AI darling, your thoughts here on NVIDIA and this AI craze that's continuing?
Yeah, so it's interesting fact. So when we think about the Mag 7 coming in earnings season, we've heard from 5 of them. 3 of them reacted positively to their earnings, and 2 reacted negatively to their earnings. There's 2 more to go, and one of those is NVIDIA. So NVIDIA doesn't report until the 20th and continues to make new highs. What's been interesting with NVIDIA, it is, as we've talked about before, it actually is the picks and shovels for the AI gold rush, right? They actually make the things you need to have an AI strategy in your business. And they're very profitable chips that increase your computing power. So to the extent that right now it's the only game in town for all of these companies that are spending billions of dollars to actually have an artificial intelligence business proposition to offer to their consumers. So who are the largest customers? It's companies like Meta, which is the owner of Facebook. It's companies like Microsoft. So to the extent that they've got very large customer concentration, and they've certainly done very well, and they likely will continue to, unless and until we get to a place where either spending on AI deteriorates, and we don't see that happening soon, or there's a cheaper competitor, someone like an Advanced Micro Devices, that can create something that helps you have enough computing power to drive an AI business strategy. So to the extent that they are the only game in town, it's not surprising. What's been very interesting about them is they've gone into most of their last 4 earnings reports at all-time highs. And then their multiples come down because their earnings releases have been spectacularly good. The bar has been set very high for NVIDIA coming into this earnings report. So I'm not saying that they're going to miss or there's going to be a negative reaction to their earnings, as there hasn't been for 4 quarters in a row. But I will certainly tell you this. They are priced to perfection, and we'll find out more in a couple of weeks when they report.
Terrific, Art. Excellent as always. And let me surprise you with the last question here, which I've been asking you for decades now. Where are you putting money now and or taking it off the table?
If you didn't ask me that question, Frank, I would think there was something wrong and might be weather-related with all the rain. I'm so happy you did. So the 3 things that we're focusing on this year is we think the market broadens out. And what does that mean? We think that there's participation from the other 493 S&P 500 companies that underperformed the Mag 7 last year. And that just means investors start to look at things that didn't do spectacularly well last year and find good reasons for why they could do better this year. Our 3 favorite sectors along those lines would be financials, energy, and healthcare. And when we think about that, it's the three worst performing sectors, or three of the worst five performing sectors of the S&P last year. Valuations look very good. In healthcare, if you didn't have one of the GLP-1 weight loss, diabetes drugs, then you were ignored. So we think there's a lot of great value in healthcare. The same thing is true in energy, and we certainly think the same thing is true with the financials. That's one of our key themes. The other is we think that there's going to be a catch-up trade in small caps. So the Russell 2000 small cap index and the S&P 500 index hit an all-time high a couple of years ago. Now the S&P 500 is back to a new all-time high. The Russell 2000 is still 24% below its all-time high. So there's a lot of mean reversion or catch-up that the small caps could do, and I think that would be driven by lower interest rates and the fact that the value of the dollar has peaked and rolled over. The peak was in October. So a couple of headwinds for small caps now become tailwinds, and we see some real value there. But in general, we think the economy drives earnings, and the earnings for the S&P 500 this year are going to be north of consensus. So if you put a fair market multiple, we certainly see the S&P 500 being able to get to 52 or 5,300, which would be a nice 10% return.
Terrific, Art. It's been fantastic speaking with you again and hearing you on the air here. We do appreciate it and hopefully get to do this more often. That is Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Also on Twitter, by the way, at Arthur Hogan III, right? And you can see pictures of Art Hogan's analysts, which are his King Charles Cavalier Spaniels, which are really, really cute. So if you haven't seen that, be sure to check it out. Art, thank you very much for taking the call here this afternoon.
Frank, always a pleasure. Thank you. Take good care of that rough weather you got going on.
Yes, sir. Thank you very much. And speaking of that, let's see how the folks are doing right now here on 790 KABC. So you've been hurt, and it's time to call a personal injury attorney. But who can you trust? Do your homework, because not all law firms provide the same care experience, and results do matter. The Fielding Law team brings years of expertise, and they're concerned about your well-being. Personal injuries can be overwhelming, but with the right ethical attorney by your side, you can navigate the legal process with confidence. Attorney Clark Fielding and his team of legal sharks prioritize transparency, communication, and results. They've been serving our 790 KBC listeners for years. Fielding Law understands the challenges you're facing, and they're ready to fight for the care, follow-up, and compensation you deserve. Before you decide on an attorney to represent you, do your homework, research your options, check their online reviews, and make sure your attorney has a proven track record in personal injury cases. Fielding Law Firm is not just a legal team. They are your advocates and trusted counselors dedicated to achieving the best possible outcome for your case. For a consultation with the Fielding Law team, call 833-88-SHARK. That's 833-88-SHARK. Your journey to justice starts with the right choice. Fielding Law Firm, where your case is their commitment. 790 KBC welcomes Train and REO Speedwagon Summer Road Trip 2024 to the Kia Forum on September 8th. Tickets are on sale now at Ticketmaster.com. Right now, caller 9 wins at 1-888-790-5222. You can get a pair of tickets to the show if you are caller 9. So call right now, 1-888-790-5222. Mottek On Money continues here in 790 KBC. A winning day for the stock market. The Dow up 141 points. We're at 38,521. The S&P 500 up 11 at 4,954. And the NASDAQ gained 11 points at 15,609. Looks like both the Dow and the S&P 500 just below the all-time highs. The price of gold at $2,051.40. Oil moving slightly higher, $73.43 a barrel in New York. The yield in the 10-year note is eased to 4.10%. Taking a look at Bitcoin right now up about $8 at 43,081. Ethereum down 4 at 2,377, and Doge at 8 cents. Nvidia coming off its all-time high, down $11 and change to 682.23. And now the latest news here in 790 KABC. Mottek On Money continues on 790 KABC. Good afternoon. We're doing it live in the 4 o'clock hour here, doing more in 2024. Mottek On Money. Weekdays at 4, 790 KABC, streaming live online worldwide at KBC.com. And, yep, the on-demand Mottek On Money podcast at KBC.com, Apple, iTunes, and all your favorite podcast platforms. Please drive gently as this latest wave of this storm roars through Southern California. The 790 KBC News Department, of course, following the very latest for you here. And let's go now to Orange County and see how businesses and folks there are being impacted by the storm. Joining us live now is Jeff Ball, the president of the Orange County Business Council, former head of the California Bankers Association. Jeff, wonderful to have you with us here this afternoon.
Frank, how you doing? I normally say it's a beautiful day in Orange County, but at least we're starting to clear up, and hopefully things are well in your neck of the woods as well.
Yeah, we don't have Chamber of Commerce weather today, certainly, but it is right around the corner, so that's the good news. How are people holding up there?
Well, we're doing pretty good down here. We've got some isolated mud flows in certain neighborhoods. We've got some voluntary evacuation in some of our canyons, Silverado, Williams, Majeska, and Trabuco Canyon, where we often have issues when we get heavy rain. But, you know, our fire authority and sheriff's department, police departments are all doing a great job. The big issue we're dealing with down here weather-wise, Frank, is the landslide in San Clemente, which once again has impacted the rail line that goes between here and San Diego. This is an important corridor from a goods movement perspective as well, not just passenger rail, but a lot of freight that goes through. But the project team is assessing the building of a barrier wall. Much thanks to the state for getting us an emergency declaration to provide some funding to do that. And the good news is we do have the freight trains back in operation today. Our friends at OCTA have done a great job in getting that up and running, and we'll hopefully have the track clear very soon.
With weather top of mind, thank you very much for that important update. And it looks like, according to Treasury Secretary Yellen, the banks are coming back in the spotlight. Remember last year we had you on quite a bit talking about what was going on with the banks and the several bank failures we saw early last year. And now Treasury Secretary Yellen today back on Capitol Hill talking about regional banks and still being impacted by commercial real estate and so forth. Says the commercial real estate losses may leave banks quite stressed. Give us your assessment of what's happening here at the moment.
Yeah, well, I think she was primarily referring to the situation with the New York bank that had acquired the failed bank, and with that took on a pretty significant commercial real estate portfolio. I think a couple of things to keep in perspective, Frank. This is a very different situation than what we were looking at back last March. Banks are very well capitalized, and for many of our community banks and regional banks especially, where we tend to get the finger pointing, you know, most of them have very conservative loan portfolios when it comes to commercial real estate. There's a lot of risk and concern around office properties, but when we're talking about commercial real estate, that's all different types of property. And for many of these banks, the actual exposure to non-owner occupied office space is actually very limited. And even within that, there are certain pockets that remain strong. So, for example, with the medical community, medical office buildings continue to be very strong with the demand that we're seeing in healthcare, particularly here in Orange County. So it's easy to get caught up in this when you have one or two particular banks that are having an issue. But we have thousands of banks across the country, and they're well managed. They're certainly well regulated. And I don't see it being the extreme risk that many are concerned about in the market, although certainly looking at their valuations, there is considerable risk. I think what's more important to think about with office properties is other types of entities that are holding this, you know, pension funds, insurance companies. That's where I'm concerned the concentration of risk may be more severe.
On there live with Jeff Ball, the president of the Orange County Business Council, former head of the California Bankers Association, the voice of business in Orange County. Makes me sound like Shirley Temple, by the way. You sound great, Jeff, and it's always great to have you live on the air with us here. And let me ask you this, turning to a more specific Orange County issues. I see you got a major Disneyland resort investment in the works. Give us an update on what's happening there at the ground level.
Well, we do, Frank, and very excited about a major investment that Disney is planning to do with the Disneyland Resort, the original resort here in Anaheim. You know, Frank, most regions, if they were told that a private entity was looking to invest around $2 billion into their market, would be trying to figure out what tax breaks they can give and how they can incent that company to come forward and make that investment. But Disney is planning to invest close to $2 billion into the park, and they are not going to do this with any type of public funding. This is all being funded by Disney, and in fact, part of their plan is to give back to the community. They're looking at $30 million towards affordable housing projects, $8 million towards park improvements that are outside of the resort area in Anaheim, and about $85 million on traffic flow improvements. So, this is a company that is not only looking to invest into the next several decades of their park, but they're also looking to contribute back to the community as well. So we're very excited. We're blessed to have Disney and the Disneyland Resort here in Orange County. Their economic impact is already significant. And with these new investments, we're talking about significant construction-related jobs, operational-related jobs, and of course, that's all going to contribute to an increased tax base above and beyond the specific investments that Disney is looking to make that I just mentioned. So we have this right now before the city. There was an informational session with the city council a few weeks ago. It'll be coming up with the Planning Commission and then the city council. OCBC absolutely supports this project and encourages other businesses in Orange County to support it as well, because this is just a huge economic opportunity for our region.
Thank you for sharing that important news with us. On the air live with Jeff Ball, the president of the Orange County Business Council. Now, what about retail crime? There's some new legislation being proposed. I know there in the OC, you guys take a different approach to crime than they do here in Los Angeles County, where you have a tough on crime DA there, right? What's happening on the? Do you have any smash and grab issues there, and what's happening on the retail crime front?
Frank, like all other regions of California, we have seen increases in crime. And while Orange County has always had lower crime rates than other parts of the state, particularly for other urban areas, we certainly have seen our rise in crime. You are absolutely correct. We have an outstanding sheriff. We have an outstanding district attorney. And we have great police departments all through our region. And that is our first line of defense. But that first line of defense also needs to have support in the state laws. And a lot of the ramifications that we've seen from Proposition 47 has led to increased crime throughout the state, and Orange County has not been excluded from that. We are working with a number of different legislative proposals that are out right now that are looking at ways that we can increase the crime enforcement, actually put some of these people in jail so that there's more of a deterrence towards some of this type of activity, particularly a lot of this organized retail theft. So we've been safer, but we're certainly not excluding or been excluded from the issues related to the increasing crime rate. And we do all we can to enforce the law here, and we have some great professionals doing it. But we want to give them a little more support and have stronger enforcement to discourage that type of behavior.
Thank you, and we appreciate all the great business people from Orange County listening to this program. And I see you're going to be celebrating soon. Hopefully the weather will be much better than it is today. What's your next big event there?
Well, we got a couple things coming up, Frank. We always have great things going on here in Orange County. Our big OCBC annual dinner will be a week from Thursday, February 15th, at the Disneyland Resort, by the way. We have already sold over 700 tickets for this event, but we do still have some available through the end of this week. Great opportunity to come and hear about some of the great investments that are happening in Orange County. We referenced just one earlier in this show, but we have others that we're going to be able to highlight and talk about. So that's coming up on February 15th. And then in April, the end of April, the week of April 29th, we have our annual Innovation Week. We do this with UC Irvine and Octane, which does a lot of work with our venture capital and startups, and that's going to be an exciting event as well. So the week of April 29th to May 2nd, a number of different speakers and events, and maybe we can even get Mottek down here to learn about some of the great investment opportunities that we have here in Orange County.
I'm definitely overdue for a visit there, Jeff, so thank you very much for that. And it's always fantastic to speak with you, and look forward to speaking with you many more times here in this new year, 2024. Still relatively new anyway. Here we are already, February 6th here. Jeff Ball, president of the Orange County Business Council. Thank you very much, Jeff. We wish you and everybody there all the best.
Thanks, Frank. Always a pleasure, and stay safe.
Thank you very much. You too. And right out to the freeways now in this rain on 790 KBC. Mottek On Money continues here on 790 KBC. Good afternoon. We're doing it live here in the 4 o'clock hour, weekdays at 4. It's Mottek On Money on 790 KBC. Turning now to China, a lot to talk about here on the geopolitical front. First of all, looks like Chinese stocks, by the way, have seen their best day in years as Chinese authorities unveiled some new actions there to shore up the ailing markets following the collapse of Evergrande, the big real estate company there in China. We're following developments there as well as other big news. We're watching what's happening with the former President Trump saying that he would impose, tariffs of about 60% on China if he is reelected. Following all these developments very closely, joining us live now is Gordon Chang, China expert and author of The Coming Collapse of China, the Great U.S.-China Tech War, and on Twitter at Gordon G. Chang. Gordon Chang, thank you very much for taking the call. First of all, on China's financial condition here, they've had a bit of a rebound in their markets, but what's really going on there?
Well, it's a one-day rebound, Frank, and essentially the sovereign wealth fund said that they'd invest in the markets. And also, over the last 3 or 4 days, we've seen a number of prohibitions on short selling, and also the national team, which is essentially state institutions, have been buying. So really, this has been orchestrated by the state, and the issue is going to be whether this changes sentiment over the long run.
I saw one report that says Chinese authorities are scrambling to stop more than the stock market from crashing. They're also trying to contain a wave of online pessimism and mockery over the Chinese economy. Did you see that? And what are they doing to try to put lipstick on a pig there?
Well, the most important thing the regime is doing is it's increasing its censorship to include now comments about the economy, because the economy is considered to be a national security matter, and so therefore they're clamping down on negative statements. They've done this in the past, but now I think they're a little bit more determined, and the reason is because the situation is worse than it has been in the past.
Right, and of course we had our Treasury Secretary on Capitol Hill today talking about our commercial real estate situation, but you had that big failure there in China, this Evergrande that we briefly talked about. Any more fallout from that massive failure there?
Well, after the announcement of the liquidation in Hong Kong last Monday, there has been really very little news. And the reason is that the court and the liquidator need to organize themselves. And they've got a very long road ahead of them because most of the assets of Evergrande are in China, the mainland itself. And Chinese courts, especially those that are controlled at the provincial and local level, are not going to honor a order from a Hong Kong liquidator. So this is going to be an extremely messy and long and dragged out situation.
On the air live with China expert Gordon Chang on Twitter at Gordon G. Chang. All right, and let me ask you about what former President Trump had to say about China and trade. If he's reelected, would impose pretty hefty tariffs on China. That, of course, was a hallmark of his administration when he was in office. What's your reaction to what he had to say about all this?
Yeah, he mentioned, or at least the Washington Post reported, that his advisors were talking about a 60% tariff. But on Sunday, on Maria Bartiromo's Fox News show, Sunday Morning Futures, he said, well, it could very well be more than 60%. What we have seen in the 2018 tariffs, which are up to 25%, was that they did not stop the theft of U.S. intellectual property, which is the reason and the rationale for the imposition of those tariffs under Section 301 of the Trade Act of 1974. So if you're looking at it from that perspective, then clearly a 60% tariff might do the trick. But certainly would be justified because the theft of U.S. intellectual property has continued unabated by China.
Another big story, the border crisis, and I don't know if you saw the report. Actually, CBS is reporting this. Chinese migrants are flocking to the southern border, and some have Chinese TikTok guides on how to enter the United States. tech component here involving TikTok and Chinese migrants. They keep repeating the phrase military age migrants flocking and coming through the U.S. southern border. What's your reaction to this latest report?
Well, the composition of Chinese migrants into the U.S. has changed. So if we look back maybe 3 or 4 years ago, 2 or 3 years, they were primarily family groups. And they were middle-class Chinese, which was an indication of desperation because of the situation in China. But recently we have seen an increase in the proportion of military-age males coming in without family members in packs of 5 to 15. And Border Patrol, U.S. Border Patrol knows that some of them have links to the Chinese military. And there has been these images of recent Chinese migrants into the U.S. in Montana or Idaho, I believe, where on a target practice with AR-15s. So that has not helped the situation when you think about what these migrants are up to when they come into the U.S.
That is alarming. I know you saw the report. It says Chinese migrants hoping to get into the U.S. are turning to an unlikely guide, the Chinese version of TikTok. I'd never heard of this before. Migrants telling 60 Minutes, I guess they had a big show last Sunday. They planned their journey using Douyin, which is the Chinese version of TikTok.
Yes, and that's really interesting because the content on Douyin is completely controlled by the Communist Party. And so therefore, allowing that is an indication that maybe they are willing to allow some Chinese to leave the country. But this reflects very badly on Beijing and undercuts Xi Jinping's narrative of a dominant Chinese state. So it is a little bit confusing why Douyin would allow all of these sort of manuals about how to get into the U.S.
All right, what kind of reaction are we seeing in Washington? Obviously, Texas taking a hard line on what's going on there at the border. I believe we also heard today from the House Majority Leader, Steve Scalise, raising concerns regarding the surge of Chinese migrants crossing the U.S.-Mexico border. And it looks like the effort to impeach the Homeland Security Secretary, as we heard in our last news report, has been defeated. So what's being done to deal with these issues that we just discussed?
Very little. The Biden administration is not tracking the Chinese migrants. And it's not just Chinese migrants that are of concern. There are Syrians, Iranians, and Venezuelans who come across the border who also look to be of military bearing. So we've got to be concerned that this is a group of countries that are pressuring the United States.
Gordon, thank you very much for that important update here, and look forward to our next conversation as we follow all these developments very closely with you. That is China expert Gordon Chang, China expert and author of The Coming Collapse of China and the Great U.S.-China Tech War. Also on Twitter at Gordon G. Chang. Gordon, thank you very much for taking the call here this afternoon.
Well, thank you, Frank.
This is Mottek On Money here in 790 KABC. We have a winning day for the stock market today. The Dow up 141 points, 38,521. The S&P 500 gained 11 at 4,954. And the NASDAQ gained 11 points at 15,609. We see oil moving higher today, right now hovering just below $74 a barrel. Gold at $2,051 and change. NVIDIA coming off its all-time high, down 11.09 at 682.23. I'll be back again tomorrow afternoon at 4 for Mottek on Money here on 790 KABC. Stay tuned now for the 790 KABC News Blitz with Randy Wang here on 790 KABC.
America starts the day with America in the Morning. Hi, I'm John Trout, your host for the latest news, politics, entertainment, business, and weather. Our staff of correspondents provide a fast-paced look at the world with specialized reports from where news happens.
In New York, I'm Sue Aller.
I'm Charles Philadelphia. Sagar Meghani, Washington.
I'm Jennifer King.
I'm Clayton.
I'm Kevin Carr.
I'm Archie Zaraletta.
Concise, accurate, and fresh each day.
America in the Morning, the podcast, available wherever you listen.